Welcome back, everyone. It has been quite the week, and I'll be honest, after the last market update video last weekend, I decided to swear off market update videos for a while. But then, every day this week was kind of like, what about now? What about now? And eventually, I decided there was a few things I wanted to discuss, and so you can see a list of some of them here. And in addition to that, there's a few things that we have been discussing for a while that I will throw in some comments in this video. So I want to start here by taking the loss because in the last video, I mentioned that I didn't expect the Fed to do an emergency rate cut. Now, I did say this weekend, but they didn't do it this weekend, but I was still very wrong and pretty surprised that they decided to already do an emergency 50 basis point rate cut. Now, why I was surprised was not because nothing wasn't predicting a rate cut. In fact, the falling bond yields were predicting rate cuts very soon and predicting many of them. But there's supposed to be a Fed meeting in what, 2 weeks? And they went from not cutting 25 basis points at the last meeting when they could have to all of a sudden can't wait 2 weeks for a 50 basis point cut. Something in their eyes is very concerning. Now, I don't know if that is just that the stock market has fallen or something else. Now, as I alluded to in the previous comments, the bond yields are collapsing. This is a chart of the US 10-year yield. And as you can see, that is more in line with what you would think of when you think of the word crash. And now, obviously, the bond prices in this scenario are going upwards with the yields going downwards. Now, this again is just the bond yields are just predicting another Fed rate cut in 2 weeks after, in addition to the 50 basis point cut that was done in the emergency basis. So I'm just wondering, I mean, at this point, the biggest question seems to be 25 or 50. And realistically, at this point, it looks like bond yields are probably going to zero, at least in the short term. I don't know about the longer term, but the Fed seems very concerned with preempting things. And if you look at the history of when they have been concerned in the past and done things like this in the past, it's not the greatest times. So why was I surprised with this rate cut? Well, honestly, I didn't think that there was enough damage done yet from the impacts of what's going on to cause this panic at this point by the Fed. Basically, I was thinking, okay, well, they might do their normal rate cut at their next meeting if they are concerned about things. But at this point, they couldn't even wait 2 weeks and had to do a double cut right away. So obviously, they're had their reasons for why we could not wait. And I mean, I didn't think we were at that point yet, at least. So on the weekend, I talked a fair bit about market sentiment and the fear and greed index and the sentiment survey. And honestly, the fear and greed index stayed pretty low throughout the week, between 9 and 15 out of 100. But then on Wednesday, and granted, there was a big run up before it, but on Wednesday, when the AAII sentiment survey was published, it seemed fairly balanced. I mean, it was 38.7% bulls and 39.6% bears. And I mean, I was expecting much more bearishness. And so that was weird. But the other thing that I noticed, and this was either Monday or Tuesday, I think it was Monday, that the put to call ratio on the VIX had spiked. So everyone was betting against volatility staying. So everyone was betting um, that, well, the VIX would fall, and that meant that volatility would fall, which is kind of contrary to everyone being bearish, although it seems that, again, so far at least, everyone seems to have been wrong on that bet as well, because whatever's happened in the markets, volatility has definitely stayed. And you could see that by the 700 to 1,000 point swings in the broader indices, and things like that. So it has been a wild week in certain markets, at least. Now, that said, there are certain sectors that seem to be fighting the, I don't know, fighting the narrative or fighting the pricing or whatever you want to call it. Because you have shipping stocks, for example, where the rates are moving up again quite viciously in certain sectors of, well, certain types of ships. And the shipping stocks are acting like, yeah, we've seen this movie before. It doesn't end well. We're not going to buy it this time. And yet the rates are at multi-year highs for this period of time, and the stocks don't seem to care, whether that's because they don't think it's permanent, or they're over levered or whatever, or they're concerned about the general economy. I don't know. I haven't spoken to them recently, so they haven't said what's up. And on the same um, same line of thought for shipping stocks, well, if refiners can't shut down, there's too much oil, where are they going to store it? So that's a bull case, I guess. Then you have gold miners, where they are they feel, they look traumatized to me. That's the best way I can explain it, because gold goes up and they inch along with gold, and then they seem to question the move, and then the general market looks like it's going to roll over, and they're like, "Oh, it was nice while it lasted, so long now," and then it doesn't, and they kind of continue inching higher. So they seem very traumatized, and they seem to be saying, like, if the market is going to crash, do we go up or down? I don't know. They seem very scared. Then you have other sectors that are frankly little impacted, and the stocks are kind of just there. There are a number of other sectors that are acting like tankers, frankly. And so it's not just the viciously cyclical sectors that are concerned right now, or terrified, or what have you, skeptical. Euro European banks are not doing well recently. They have been moving down in a straight line, just like bond yields. And there's also some others, maybe travel impacted, airlines, cruise lines, not that one. And the stealth cyclicals are not buying the everything is going to be fine narrative, by the looks of it. One thing that is kind of surprising to me is that the dollar index is actually down. I would have expected a flight to safety, taking the dollar index a bit higher, especially given the action in the euro banks. But no, it's actually down to 95, 80 something. And that's not what I would have expected in this type of scenario. Now, I know that the Fed did do a surprise rate cut, and that many people probably weren't, well, some people at least probably weren't expecting that. But still, that's odd. And the most confusing aspect of what's going on, especially for me and what I look at and focus on, is that I'd have thought with this type of central bank reaction that the commodity prices would be lower. Now, I know that they're far from high. That's why I'm watching them and looking at investing in them. But with this type of concern, I'd have expected copper to be, I don't know, 230, $2 ish, but it's still at 250 something. And I mean, this is a level that it was at in December. It it kind of rallied, maybe not December, but late last year. It rallied, but it's just kind of back. And I mean, zinc too is at 90 cents. And I mean, it went to 60 cents in the Great Recession. And I mean, I'm not saying we're there yet. I'm saying that the central banks seem concerned that we're heading there. But again, we didn't have a boom. We didn't really have a big boom recently. I mean, and depends on what. And the prices were high, but they weren't sustained high in different things. So one thing that might be kind of supporting the price to some degree is at least for energy. Energy, I was writing something and I'll probably finish it today or tomorrow when I have time about the different types of energy and how they each, well, the fuels at least, are each kind of trading below the cost of production to some degree. And I know that they're they're not as low as they've been, but trading below the cost of production is already kind of an unsustainably low level for this level of production. And so this, I don't know, this just seems confusing. I'm really surprised at how the metals have held up, given what seems to be going on elsewhere. So what's different this week as opposed to last weekend? So I don't want to make any calls this week because there's so much going on and it's shifting very quickly, and there's a lot of back and forth policy intervention and change. I mean, this is kind of as expected. When the market goes down, there's policy. Now, it doesn't always work, but there is a concerted effort to, well, my favorite description really is plunge protection team. And I mean, that's really all you need to know in terms of what the Fed is trying to, what the central banks really in general seem to want to do. So, but yeah, this week I'm not gonna, last week I kind of sounded one direction or the other. This week I want to really sound like I'm not making any calls. And I hope to have conveyed that because I don't really know what's going to happen next. And most of my focus, most of what I do is focused on the longer term. And I just kind of peek in sometimes to the market. And if I see something, I'll point it out as potentially relevant. But now there's a whole lot going on and really hard to tell. I don't have any strong views, strong convictions, and something that's changed at this point. Thanks for watching, everyone. That's it for today's update. And remember, nothing here is investment advice, although I do hope that you found something useful in this video. And with that, I will wish you a good day and good luck in the markets.